Easy to take time out of your activities to come to a very boring and technically rife presentation on pensions and divestments, but I'm going to be trying to make it very interactive because the point of this is not to just go through the presentation, it is to actually ensure that everyone gets a basic understanding of how pensions are being administrated and the scale of the UK's complicity in violations of international humanitarian law wherever they're happening, because this is a very important moral endeavor for us, let alone how important it is for pension goers' own savings as well. So let's break this down. So we have a total of at least 400 billion pounds anywhere across LGPS. I'll provide background in the later slide. The idea is that the administration for these pension assets is really divided. It's not really standardized. So you get multiple nuances. We'll cover how it changes for the London boroughs and we'll cover how it changes for the county councils. But essentially, if you've been on a pension committee or if you've been working on divestment, you might find this a little bit basic. But if you're just coming across into the pensions landscape for the first time, then the idea is that it brings you at a basic level playing field so we can actually have meaningful conversations about a combined strategy forward. So, with that in mind, you'll be able to see a very big 12 billion pound number at the end of the slide. That's basically verifiable exposure to assets linked to Israel, based in Israel, or directly with the Israeli government. And we want to actually first explore exactly how that happened and what is the legal justification or the fiduciary justification for this being the case. So let's start here. Right now, we have almost, you can see 402 billion pounds across the LGPS pot. Out of that, as I mentioned, 12 billion is verifiably exposed. However, there is a lot more that we can't verify through publicly available information, but there are databases available that we can look at. I don't want to make it more complicated than that. So essentially, we see the breakdown that you see in front of yourselves. So almost 5 billion pounds is across the tech giants. So that's a separate bucket. We're not going to talk about what do we do about those. Let's just first talk about what is happening. 450 million alone is for arms manufacturers like BAE Systems, 90 million for Raytheon, 80 million for Caterpillar, and then almost 30 million for indirect Israeli government bond exposure. We want to first understand how we got here. But before we do that, we want to understand what are all of the different asset classes or the ways in which this investment happens. So, and by the way, feel free to raise your hand. And even if there's something in the chat that you want to put in, Anima, I'm going to request you if you can read it through or stop me. So if there is something in the chat that I miss, we can also go through it. Okay, so now we get to the fun part. What are the different measures or vehicles through which investments get made, right? So the first one, what we've seen and heard a lot about, and we want to break it down as well, is sovereign debt. This is basically money that any government is saying to the world at large to lend them. And then the government is going to pay back the money for a certain period. That's basically the bond's maturity date. So if it is a 10-year bond, then you're lending the government money for 10 years. And then after 10 years, the government pays you that sum back with interest, whatever the interest is for that bond. And right now, we've got a lot of exposure to the Israeli government just through the pension pot in LGPS. Then we have public entities. So pension funds are going to be participating in different fund managers programs, and each fund manager will give you certain types of risk and profitability ratios based on which you're going to be putting money as a pension fund into those funds. Now, a fund manager can select where your money goes. The issue is that a lot of these funds work on benchmarks that are just set up. So, for example, if you're trying to invest in a fund in emerging markets, so you may want to have some exposure to Bangladesh, Vietnam, Malaysia, but then Israel is also included in those emerging market benchmarks. So, unbeknownst to you that you're doing something good by investing in emerging markets, you may also be going into companies listed on the Israeli stock exchange. And then you have the private chains. And this is one of the most elusive and hard to find investment value chains. So, for example, if a pension fund has placed money with a venture capital firm. The venture capital firm has specifically raised that money for a fund. That fund may be investing in multiple companies across the globe. So then cybersecurity, technology of any other kind, specifically on weapons side, you may get those investments trickling in to Israel as well. So we will talk about what can we do for all of those. So let's just first go back to bonds. When bonds are bought, and this is the case study where Anima and I have had some very productive progress here. So we looked at LGPS Central because right now it's managing over 100 billion pounds. When we started to look into LGPS Central, it was managing around 61 billion. A couple of the county councils have also joined in. And what we're seeing is that when each council joins, the money is going to be pooled into LGPS Central, and they're basically getting the same treatment because the councils themselves may not really know exactly where the money is going. So when we started looking into it, we realized that publicly available records on the LGPS Central website have a complete list of all of the holdings that are publicly listed, including bonds, on their website. So we went through year by year, and each year they issued two reports, one in March and one for September. And we realized that there was significant exposure to Israeli government bonds. When we found that out and we converted that into brochures, and the next council meeting was coming up, and we shared this information on the brochures with councillors, we were sitting in the gallery and we were seeing councillors reading through those brochures during the meeting. And when questions started coming in, it was interesting that we had submitted the questions before, and we got an email from the CFO of the Nottingham City Council saying, "Can you confirm what your source is for this information?" And we found that incredibly surprising because the CFO of Nottingham City Council is asking us for information that's publicly
It
available
was
on fund management's website.
Nottinghamshire County Council pension fund. Yeah, county.
Yep.
Sorry.
Thank you so much for that. That's actually even more important. I'd misrepresented that. So we're actually seeing how there is a big mismatch between what is happening on the fund management side and what is actually happening on the administrative authority side. So conversations like this are very important to know where to find the information. But essentially, when we started communicating that information in the next fund holding report that they issued, their entire holding for Israeli government bond exposure had been liquidated. So they had divested from that. The idea is that the more we find this information out, the more we actually bring it out in the open, then they actually have to either defend it or they have to liquidate. And that's essentially the work that we need to do. Similarly, for public entities, we'll cover that there are multiple banks and complicit entities that are continuing to get exposure to the UK government pension schemes. And that's not really happening just because of fiduciary duty. Essentially, a pension fund wants to try and maximize the returns, right? But why would you maximize returns by investing in government debt or listed companies in a government or in an entity or in a country where human rights abuses are happening? That could open you up potentially to huge lawsuits. And that is the problem that is either not being addressed or people know that this is happening, and yet bureaucratic trapdoors are being created. I do see a hand up, so I'm happy to take the question.
Hello, can you hear me?
Yes.
Yeah, great. I'm sorry this cuts across what you're discussing, but I'm pleased to ask it because I know that lots of us are far more ignorant than you suspect. I don't want my pension fund to be invested in anything to do with Israel or many other areas. So I'm happy to withdraw for that reason. But I'm still not sure quite why my withdrawing my funds or my 10 billion pounds of funds, why does that damage that company? How does it damage them? Because somebody else will think, oh, that's a great investment. I'm glad it's going cheap. Let me snap up those shares.
Yep,
Do you see
absolutely.
what I mean?
I completely get it. And that's essentially the thing that they want us to believe. Look at it this way. If I have an apple and everybody wants that apple because of how good it tastes. Amazing. But if the apple's reputation is tainted, if the brand value of actually owning that apple is so bad, there is definitely going to be a dip in the pricing. And I'll even give you the actual and more officially backed reason. Right now, for companies and government bonds that get made part of fund benchmarks, right? So, for example, you have the S&P 500, you have multiple other benchmarks in the world. These companies, unbeknownst to you, are already in those funds, so no one is actively making a decision to buy their stocks. Just because people buy into or fund managers buy into those benchmarks, their money is rolling into these companies. Now, what if for a fund being benchmarked and they're doing their portfolio construction on what companies should be in this fund, they have received so many requests to exclude these companies that they end up creating screens for Israeli companies that cannot even make it into those funds. That is where you cut off the institutional and real big money access that these companies need. And when that happens, there is going to be a huge dip in the demand for these stocks. And when that happens, the price will also go down, and that will start creating problems for the management of the companies. Does that answer your question?
It partly answers it. Thanks. Uh, so you cause a dip. Great. How long does that dip carry on for? Because once I've withdrawn my money, I can't do anything else. It's gone. I can't withdraw it a second time. So there'll be a dip, and then people will forget about it, maybe, and the price will rise again. The value will rise of those companies.
Yep. So look at it this way. If, for example, there is a company or a class of companies that are currently excluded from different fund benchmarks, right? That is
Yeah.
when even retail investors are not even going to those companies because they don't know if these companies may survive. The idea behind it is that the reputational damage and the screens against these companies coming into institutional benchmarks is going to create enough of an incentive for for the company management to change. So essentially, you've seen what happened with Starbucks. Just the boycotts themselves have created such a problem, not just for the people invested in the company, but an exact problem for the buyers of the company. The idea is that we are currently having a conversation on pensions, and the pensions lever is that you do not invest in those companies. But these companies also have clients, and the clients also, in a lot of cases, have reputations associated with being in business with this company. So we can have a longer conversation about the chain effects. But the first order of business is to ensure that the UK pensions exposure to these companies is limited enough, because the alternative is that we're going to continue to talk about the moral case of doing it while also reaping the financial benefits of being associated with these companies.
Okay, thanks. That certainly helps. Maybe I could summarize that by saying, uh, if you start off with a significant investment, when you withdraw it, the effect snowballs, sort of thing. Uh,
Absolutely.
yeah. Thanks very much. Sorry to disturb what you're saying.
No worries at all. And then essentially, you can create exclusion screens, as I was mentioning. And this is a very good question because this actually talks about what we can do. So if you create exclusion screens into the ISS in the presentation, which means the investment strategy statement, let me actually open that up because the question that I got, I just want to make sure I really make it a point to simplify this as much as possible. Every council, when they pool their money with a pension pot, they have an investment strategy statement. That investment strategy statement basically becomes the Bible for the fund manager on what they can offer you. If your investment strategy statement says we just want the biggest or best return, then they're going to be investing in giving you the best return. But if you say that my investment strategy statement needs to have exclusion screens for companies that are violating international humanitarian law, are on the any of the ICJ lists, or there are multiple other lists that we can use, then that becomes a shield for your money, that it wouldn't flow into complicit assets. And then the last thing is that we can even ask for binding side letters for investment, which is something that the pension committee can do, and also have the fund managers conduct detailed human rights risk assessments. The interesting thing is for all of the talk on sustainability, up until 2022, no global sustainability frameworks actually accounted for human rights as an actual environmental, social governance, or sustainability issue. That's the sea change that we're seeing today. So from here, I actually want to talk about the nuances for where people might be sitting. So we may have some people who are elected councillors here, ex-councillors, or people who are working with councils, but it is important to know what your council is empowered to do or what your seat is empowered to do. So if we talk about councils for cities, districts, and counties, for example, the Nottingham City and Nottinghamshire Council, they don't control their own funds. The way it works is that the Nottingham City Council, the funds are administered by the Nottinghamshire County Council, and their funds are actually going into the pension pot, the LGPS Central. So as a result of those layers, you cannot directly control what those funds are used for, but in the motion that we helped draft, which got approved by the Nottingham City Council, they are now mandated as a city council to write to and recommend to the county council all of the measures that we've put in place. So they cannot dictate, but they can recommend. And we can also talk about our investment strategy statements. But that will create a roll on effect if all of the other large cities and county councils who are part of the LGPS central pool continue to do the same. Contrast that to the London boroughs. We have a lot of people from Greenwich on this call, and the borough legally owns its own independent fund. However, they will still, for let's just say economies of scale purposes, choose to pull that with other pension pots, and in this case, it is London CIB. So to make that work, there is statutory power that these councils have, and that's where the investment rules will come in, and we'll talk about that a little ahead in the presentation. Now, I wanted to do a quick visualization for how it works. So the council is putting its funds with the pension panel, and the pension panel is then giving those funds to the asset pool and the asset pool to the external manager. But let's break that down. Let's say it is the Nottingham County Council. They have their own pensions committee. The pensions committee has decided which asset pool they want to work with. So could it be Border to Coast Pension Plan, LGPS Central, it could be the South Yorkshire Pension Authority. And then the asset pool itself isn't also going to administer. For example, they will choose an external manager to take the funds and invest it. So now imagine that a council is passing a motion and even at the county council level, in a lot of cases, it isn't going to be an immediate implementation. Systems and safeguards are going to have to be put in, and then we need to apply governance on top of it. So, what I mean by that is if we have made a binding commitment that something needs to happen, then you also want to put in let's just say, regular reviews of what needed to happen. So even in the Nottingham City Council motion, we're talking about the officers reporting back on the exposure that the post-motion portfolio needs to have. If I can simplify it, if you want your child to do something and you tell them something once and you say, this is your father or your mother's red line, don't go beyond it. If you don't check for it, they know that there is no balance. They know that you're not enforcing that line. Essentially, it's the same governance that needs to happen. And the weapon for that is the investment strategy statement, ISS, which is the master rule book that your council controls. That's what we need to work on changing. So after this, I wanted to do a little bit of a breakup on what the different terminologies mean. Before we do, this might be a good time to quickly take a question or two. If there are any, feel free to chime in.
So if anybody wants to raise their hands, in the meantime, there are a couple of questions in the chat. So the first question is the fiduciary responsibility of investing in an ailing economy like Israel trumped by the risk of being fined for contravening human rights law?
Correct? Yes, it is. There couldn't be a clearer case for that.
Okay, thanks. I think we've got a hand up. Isabella, go ahead.
Thank you so much for the summary so far. It's been really excellent. Um, I may have misheard you, but did you say that in London we can choose whether or not to pool? Because I
Yeah.
thought that wasn't the case.
Yeah, the boroughs actually have that choice. So it is a choice to pool, and the financial argument to pool is that when you pool and are part of a bigger fund, then you get access to better deals. It's basically the same thing when one person may not be able to afford a house, but when two or three people combine together, they have enough money to actually afford the house. So that's
Mm.
the financial reason why pooling happens, but it's not a requirement.
Really, I thought it had become like a set statutory requirement, so that's really good to know. Thank you.
They're trying to make it one. So if you think about it from a so Rachel Reeves, when she took office, she said that the UK pension funds should look to the model of the Canadian pension funds. The reason she said that is that the Canadian pension funds are much, much bigger. I'll even give you an example. I just gave it in a meeting that I was in Greenwich last week. We've seen that the overall pension pot just for LGPS is a little over 400 billion pounds. That is less than what one pension fund in one state of the US for just a particular type of government employees has. So CalPERS, the California Public Employees Retirement System, is already over just their assets under management are more than the entire LGPS pension pot for the whole of the country. That's why there are benefits in pooling because you can get access to assets that you wouldn't be able to afford or have access to otherwise. That's what the government is trying to do. That also reduces your fund management costs because they are divided now. You're basically paying the same fund management professionals, but then the money or the value for money that you're getting across multiple councils is huge.
So just to interject, Shaz, because I think there are a few questions asking here. Like, I thought Rachel Reeves had introduced a law requiring them to move all funds to the pool by the end of March 2026, and someone else says this contradicts what they've been told. So it's like basically, it sounds like council has been told that actually there isn't a choice.
Yep. So the government is trying to force its way for the pooling to happen because they look at it as the only way to right size things. So we know that the local government reorganization is also happening because we have too many councils and too many councillors. That's what they're saying, right? So then all of the powers and all of the accountability is going to then concentrate in a few people, but then theoretically, it also saves a lot of the expenses that we have on multiple counselors. That's exactly the same thing that they're trying to do with pooling of the pension assets.
Okay, thanks. We've got Tracy Haig, who I know is the chair of Croydon Pension Fund. Go ahead. Have we lost? Are you there,
No,
Tracy?
I'm here. Sorry.
Okay.
I'm not the chair or the vice chair of the pension committee, sadly. And only the chairs and vice chairs get to sit on the LSIV one across London. So that's already out for me. I had my first pensions committee meeting last week, and I was a sole voice talking about divestment of any kind because we've only divested of tobacco. So we're still investing in gambling and pornography and fossil fuels and everything else. We were told repeatedly about being apolitical, that there is a fiduciary duty to maximise the value of the fund. Although it hasn't performed very well the last quarter, it has performed pretty well the last 3 to 5 years. But also, they had got advice from a KC that basically said you can't divest unless the government says so. So until the government imposes sanctions, you can't divest of anything else, which seems to go against the fact that 25% of councils have done it, and also there's a track record with apartheid back in the 80s and 90s. So, are you
Yeah,
shedding any light on that, please?
absolutely. This is the perfect question for this slide. So let's go through it. And after I cover these 2 points, we're going to take questions because I see Elsira and Rob have their hand up as well. So let me just quickly cover this. They talk about fiduciary duty, and fiduciary duty essentially is how do you maximize the return for the assets that are invested? And the Law Commission, interestingly, does allow ethical exclusions where you show that scheme members support them. So it has nothing to do with just the government saying something, because this is not the government's money. This is the scheme members' money. That's essentially the argument that you bring up and say that scheme members who have decided to make this contribution, they're saying that they want ethical exclusions and that there should be no significant financial detriment. Even when there is slight financial detriment, those disinvestments or divestments are still allowed. The problem is that no one is going to quote the Law Commission back to those officers. And when you do, they're going to go back, and their response to you would be, we need to get legal advice. When they do get legal advice, then what has happened in Greenwich, and Lubna was amazing on this. I looked at what Greenwich has been able to achieve. They are able to provide those exclusions, but the officers are not, let's just say it is not in their best interests to take on more work for the same amount of remuneration they're getting. It's just a lot of headache. It's not just something of a financial benefit, it's also that it's a completely different precedent that they have to work on. And the security for not changing anything is actually much better than the moral duty of actually taking action. So we can talk about that separately. The second point was that human rights simply aren't financially material to the fund. And this is my personal favorite, because by day I work with pension funds, development finance institutions, fund managers, to talk about these things. And by night, I share that same information with non-finance folks who are interested in divestment. So essentially, what's happening is they're trying to convince you that there is absolutely no harm in continuing to invest in entities that are complicit in human rights abuses just because they bring in money. The problem is that we have historical precedents when investing purely for financial gains has actually been detrimental to financial value long term. I will give you an example. If you wanted to invest in the most profitable stocks pre 2005, British Petroleum would have been on your hit list. You would have invested in that stock and continued to make money until an oil spill happened. And the fine from that one oil spill was enough for British Petroleum to have to sell half of their assets globally, right? So we're only talking about short-term financial gains and saying human rights are not material to fiduciary duty. The difference is, and this is the part that most people don't understand, and I feel incredibly privileged to share with you, fine people here, is that all of the risks that are medium to low today, for pensions, they become really high because pension investments are being done on a generational time span. You're not just investing in something on a 5, 10, or 15-year horizon. You're looking at something on a 20, 30-year horizon. So I've even been on the receiving end where I was talking to a very large pension fund, and they were thinking of investing in a shipping company, and the fleet of ships that they have are all diesel powered. So they're thinking 25 years from today, is this still going to be a viable investment if the price of diesel goes up? If there is carbon pricing where however much you emit in emissions, you actually have to pay in taxes. If the governments actually outlaw fleets that are diesel powered, if ports start moving away from ships that are still running on non-renewable energy. So those are the essential conversations where you start thinking about risk on a long-term horizon. So when you are told that human rights aren't financially material to the fund, then you have to ask the fund manager if they are really focused on fiduciary duty. So if you can use fiduciary duty to talk about human rights, and you can talk about human rights to talk about the fund making money. So I'll stop here. I do see a couple of other hands up.
Just very quickly before the next person asks a question, because I think there's a very relevant question in the chat right now. Are there ethical funds that perform better than the ones that are currently being invested in? I.e., is it financially prudent to invest ethically?
It is definitely financially prudent to invest ethically, but the problem is that depending on who you ask, they can convince you of whether ethical investments are good or whether non-ethical investments are good. Let's just look at it this way. You can governments do it all the time. They play around with numbers to make you think that their progress is much better than what it actually is. It really depends on where you start measuring from. So if a fund manager tells you that divesting from a particular asset or providing an appropriate exclusion screen is going to have us lose money, they may show you the short-term loss that they took, but if you actually look at the losses that pension funds have been taking in the past years, even without exclusions, those losses may actually be much more than any potential losses they actually think will occur through divestment. And that's essentially why I have created, just like people on LinkedIn these days are sharing prompts that you can put into Claude to give you better responses. I've created a statement that you can provide to the officers in the council to actually ask them to do the calculation. Because losses and profits are a staple part of everyday investing, and they're taking that one small blip to disincentivize people from talking about divestments. There is no real conversation about numbers that are grounded in a fair assertion of how ethical investments would actually be much better long term. And it still is a moot point because this is the scheme members' money. And if they want ethical exclusions to be created, it is their right to demand them. Anima, back to you.
Thank
Any
you.
any
Thank you.
questions that we need to work on before we move on?
I think we've got a question. Gwen, do you want to ask your question?
Hey, thank you so much, by the way. This is great. I just wanted to ask if you had, because something we've been trying to figure out in London is the degree to which the ISS documents from London boroughs are like legally binding on the Civ, or whether the Civ could get away with saying that they're just kind of advisory and they'll do their best. And are there limits to what councils could include in their ISSs such that the Civ could reject them? Like, what degree of discretion basically does the LCIV have in the implementation of individual councils' ISSs? And if you do have that information, if you could signpost to where you've got it from, that would also be really useful. Thank you so much.
This is a wonderful question, Gwen. So basically, we need to look at the constitution through which the LCIV is administered, right? So, and the problem is that lawyers have a way, as Anima can attest, to make the interpretation go either way. Technically, the ISS is the document that any administrating authority can use to basically get its exclusion screens added into what the fund manager will offer you. The problem is that they might take one of three routes. The first is, well, it's not a big enough pond that we could actually apply to the investment strategy statement if only one borough has it, right? That could be one way to look at it. The second way to look at it is, oh, we only look at it as an advisory capacity because at the end of the day, it is the fiduciary duty that is important. And then the third one could be, no, we need a motion from the committee and then overall from the board, a motion needs to be passed that we could actually do something because this requires government mandated, whatever the terminology might be used, right? The problem with all of this is that right now, we don't really have a cohesive strategy. Every group, you might say there are multiple groups working for the Palestinian cause or for the cause of international human rights, meeting up with those targets. But there could be petitions going on, there could be changes in investment strategy statements. There never is enough of a volume that all of the participating councils have at least one point that is common across investment strategy statements. That is the thing that really bites us back. So, what we need to do is to be as organized as the other side is and have our arguments as steeped in the, let's just say, meeting up of fiduciary duty as the other side does. I am not saying that we should be doing this just because of a moral duty. Yes, I believe it in my heart, but I am saying this is actually good for pension savers. So if we are able to create exclusion screens that save us from investments that we don't know what sort of adverse effects they're creating, not just from a financial perspective, but just because of technologies and chemical warfare or problems that the environment is having. We're here talking about decarbonization, but countries are waging wars that are creating emissions that are not even looked at in any screen, which will actually come back and create climate change disasters for us back home. So we'll look at the different arguments that can be provided. But essentially, you're on the right track. We need to have at least a standardized line that we can tow across investment strategy statements for all of the councils that pool with London Civ.
So I know that Gwen is working on that with Shahzeb, and I think we have some other people here who have been. Maybe we could put that towards the end of the meeting and discuss specifically the statement, because I know one of the drafters is also on our call, and Shaz, you've looked at that too. Okay, so let's move on. Yeah.
Okay, so I'm going to make this one quick. So we've actually seen that just like we are trying here to de-escalate the increasing exposure to assets that are deemed and verifiably complicit in the genocide happening, we've seen that in 2021, just if we talk about LGPS Central, the overall exposure was just civilian software less than £500,000. In 2022, that jumped to 7.4 million, specifically going to arms manufacturers and entities that are financing mortgages, insurance, and all of the other construction and settlement activity in occupied Palestinian territories. That is documented, that is proven. And now in 2025, that has now increased to arms and occupation banks, insurance companies, and pharmaceutical companies that are specifically benefiting from the land grab that is happening. So you can call it annexation, you can call it assertion of land rights. It's essentially the same side of the same two sides of the coin. But what we want to the reason why I'm mentioning this example is that we are actively trying to work on this de-escalation of this exposure because an active escalation of this exposure has happened in the last 5 years. There is a lot of research material, even publicly available, where, and Anima, I would really appreciate it if you can even share the work that has already happened across all of the pension funds, and we have the spreadsheets available that show the year-over-year exposure. So when people say that we are just working to on fiduciary duty, why has fiduciary duty specifically gone in to increasing UK pension goers exposure to arms companies and companies that are financing illegal activity globally? So that's an important question that we can put in investment strategy statements. And now we talk about the screens.
Sorry, could you just go back to the other slide? Because I just wanted to point out something. Yes, this one. So anyone notice the name of the bank there? So Bank Leumi, that is one of the banks that was offering financing for the great real estate, Israel real estate thing on Sunday. Their name was there in all the brochures. So just so that you note, and I can tell you, I think all of the pen asset pools, except maybe one, has quite significant investment in Bank Leumi. So that is one thing to start looking at for your pension pools.
Amazing. Thank you so much for that, Anima. So one thing that I feel we are guilty of doing is that we talk a lot about individual companies. And while that is good to work on as activists, but for this meeting specifically, when we're focusing on pensions and divestment, we don't want councillors and people involved with councils to be talking about individual companies. The problem with that is that money is fungible, and so is the nature of the exposure that you have. So essentially, if you talk about individual companies that the fund holds right now, and you do a long slog of 3, 4, 5 months until you get to a meeting and you say, well, these companies are complicit, they can just say, well, we liquidated that a month ago. And then you're back to square one. What you want is not to talk about Elbit or Raytheon or Caterpillar. What you want as a conversation on pensions is to mandate an automated filter on multiple databases, whatever databases that you feel are the most credible, right? So it could be the UN and ICJ databases or global authorities that really have a watch on what are the criteria that need to be met for a company to be blacklisted. And then, as long as those exclusion screens are available, you will not be seeing at least this head of the snake come up, because you do not want individual screens, because a company may be called one thing today, It might be called another thing tomorrow. It might be bought by somebody else. You want exclusion screens that specify the criteria that is always checked for, and that will keep your portfolio safe from entities that might be complicit. That was an important point that I feel even in conversations with councillors or as we work on campaigns, that most probably gets missed. And that's essentially completely contradictory to the way the officers of fund managers work. So going from here, what are the low-hanging fruits? First of all, for counties, we can target sovereign bonds. And that can happen as the easiest liquidation to take place because obviously, as we had a question before, somebody else might snap that up, but at least we do not want direct exposure to governments that are directly complicit and responsible for a genocide. Then for London boroughs, I would highly recommend launching a worker consultation. The more of these you do and the more signatures you actually show, that gives you grounding to actually talk about the same pattern, that same standardization across the investment strategy statement that you want on those automated exclusion screens that we've just talked about in the previous slide. And then for cities and districts that don't have direct control of their pension assets, yes, you can recommend what you want your administrating authorities or county councils to do, but you can definitely follow Oxford's example, where you can review commercial banking and procurement contracts with vendors who are complicit. So the Oxford City Council's review of their commercial banking with lenders like Barclays is an amazing example. And then just in 2025, we've seen, even though it's happened quietly, but Border to Coast has liquidated almost 29 million in direct Israeli government bonds. London CIF has divested almost 7 million. So that's essentially the sort of progress that can really happen. What we need to do is to make sure that we keep a tab on all of the milestones that are being met, but then in the process, not lose sight on what it would take to systematically, completely sever our exposure when it comes to entities complicit in human rights abuses. Now we talk about exactly the wording. So I do see a question though. So Sabrina, do you want to go ahead?
Yeah, maybe you'll answer the question like with this actually slide, Shaz. So, but I'll ask it anyway because I mean, out of curiosity, because we always mention like, okay, let's say like as a counselor or like as a pension committee, I say like to the fund manager, okay, I don't want any company that is basically violating like the ICJ or UN like list of criteria. But how are these criteria enforced? Because sometimes it's basically companies saying, oh yes, I respect the human rights, but then there's no control whatsoever, like it's a sort of like self-policing, if you know what I mean.
Absolutely. So it's the art of putting in clauses in a motion without giving it teeth. So if you don't give a clause teeth, anything can pass an emotion, right? But it's the actual implementation when the rubber meets the road, you're going to start seeing problems. So we'll talk about the exact phrases that can be used. And Anima got me to review a draft of an investment strategy statement and all of the changes that I made, because again, lawyers don't miss anything. So it was a very hard hitting investment strategy statement, but none of the governance mechanisms had been mentioned, where, for example, every 3 months they have to submit a report of the screen that they actually conducted. What did they exclude? And for the companies that they say they wanted to engage with, what was their time frame for that engagement to actually bear fruit? And if that engagement didn't tip the company to the outcome that we were expecting, did they vote against the company chair? And did they make a plan to divest from the company within 6 months? All of those are things. It's basically where you talk about dreams and goals, right? Dreams are when you have deadlines with dreams, they become goals. So essentially, everything that we're adding right now is all dreams. We just need to put deadlines and governance lens on top of it. So now we can talk about the point that I was trying to make here. So how do you create an unshakable motion? So if you say that the council condemns human rights abuses of a foreign government, the solicitor is just going to block it because it exceeds local government powers. But if you say that we want pension assets to systematically exclude corporate entities operating in territories subject to adverse findings by the ICJ or UN, that is nothing related to what local government powers are. That is a real part of your investment strategy statement that you could put in, and those exclusion screens then will have to be honored. And if they're not honored, then you can fire the fund managers. That's actually cause that the fund manager is not adhering to the implicit contract that the investment strategy statement is supposed to be taken seriously and options for investment offered to you just based on the ISS. So now let's talk about what happens when we get stalling, and that's essentially the question that we just got, right? Because every one of the LGPS pools, I was really shocked to see this initially when I did a couple years ago and a little depressed as well, that everyone was talking about engagement. Because again, engagement is how we continue to still be present in complicit entities while talking about fiduciary duty. Because again, it gives us a seat on the board, we can write to the company, but how do you make a company change its ways? Just think about this. There have been lawsuits against the management of large oil companies to try and get them to decarbonize. And now the companies have started suing the investors back. Because again, that goes against the capitalist system and the values, right? Essentially, if a company's entire business model depends on an activity that you wanted to change, well, a leopard's not going to change its spots. So, what needs to happen here is that we need to have a time bound escalation, which is essentially the governance part that I was talking about in the ISS. So, they're saying that we'd rather keep our shares in Barclays or BAE because our votes will make them more ethical. No. But if they say it, great. Now we can actually say, look, we're not saying engagement is bad. We just want you to prove that your engagement is working. Then you start having a conversation about what happens when your engagement isn't working. So that's how you can actually put in this clause. So if a manager engages a company on the UN OHCHR database and it doesn't exit the occupied territories within 12 months, the manager must vote against the company chair and divest within 18 months. That is a very, very, very specific example of a company that is operating in those territories, right? We can have multiple other different types of exclusions provided in the ISS, but it requires knowing how the system works, and it also requires engineering clauses in a way where governance and its implementation can be ensured and put in as part of the system. So now we talk about the takeaways. So I would highly recommend that all counselors email Democratic Services and get booked onto the free LGA Pension Fundamentals course. That's essentially a very important, I would say, fundamental requirement for anyone serving on pension committees. Then you want to get your own investment strategy statement, find the responsible investment section, and be prepared to get highly surprised by when the responsible investment section may not prove that the responsibility that you're thinking it should have, it doesn't. So then you actually start thinking about, okay, what does it not have? And I'm very happy to have conversations around how to make recommendations for additions or updates in the ISS in order to make sure that systemic exclusion screens are added. And then lastly, we need more counselors on pension committee seats, right? As I have written it here, one trained counselor, trained is the right word, or well, I would say educated, educated in pension fundamentals and ethical divestments. We can come to that, but one trained counselor inside the committee is worth 10 just making speeches outside. And that's essentially my content for today. Thank you so much. I know I had promised 30 minutes, but I believe with questions, we were able to cover a lot more ground than initially intended. Okay, so they try to do what I call the transition cost bluff. So they say once fiduciary duty is taken out, they say our costs are going to be very important. And they may say that moving 500 million out of this fund will cost 2 million in transaction fees, broker spreads, exit penalties. And that's essentially where you can ask them to give you a transition cost weighed against the 10-year risk of holding assets vulnerable to sanctions and ICJ liabilities. That's just one way to frame the question. And I guarantee you, you're not going to get a knee-jerk response that they'll think about it and say, well, it's difficult to put it together. Again, they're fund managers. So fund managers' whole job is to create risk-adjusted ratios and analysis for where the investment is best suited to go, right? So they're saying that if we exclude pillars one and two, we're going to have to spread out the risk. The problem is that whenever we start having conversations about divestments, people are going to start talking about even for as an example, big tech, because Amazon, Google, Meta are so profitable that they'll tell you that no other asset class is going to come close to the returns we're getting. But here we're talking about not just those companies, we're talking about a lot of low-hanging fruit and even smaller exposure. So I will give you a it's a funny example, but when we initially started talking about divestment, officers at the Nottingham Council came in and they said, well, you're talking about investments that make up a really small part. So even if we do anything, it's not going to matter to the overall scheme. And then when they said, well, it will matter, they said, okay, but then it goes against fiduciary duty. Well, if it was very small, then the risk of getting out is also small. So how does it then compromise fiduciary duty? So anything will work to shut us up. And we are not going to come up with questions to actually poke holes. That has been essentially my observation. If we talk about a 10-year weighted average risk adjusted ratio for what it costs to make the transition, and then weighing it against the cost of actually staying invested in entities complicit in ICJ that are blacklisted in an ICJ lists, well, that's a completely different calculation. Again, you can wrap around statistics any way you want to tell the story, and that's exactly what's been happening here.